Does the labor market remain strong? This is the big question or elephant in the room, if you will. You, like I just shared, hear all these folks who are cutting, reducing, downsizing, not hiring. And then these reports come out about how there's thousands, hundreds of thousands of new jobs being created. And from my perspective, and I talk to many sophisticated folks, they're all in the same boat saying, where is this data coming from? Is it accurate? Is it 100% correct? And then obviously, as you all know, or should know, months later, they'll revise the data. By that time, it's old news and it's past and it's not really talked about. And they'll revise the new jobs reports way, way down. So I think the data that you got coming out is not 100% accurate. Hey everybody, I'm Dan Brisse. Welcome back to another episode of Keeping It Real Estate. Today, I'm talking to you guys about one of the biggest macro stories this week is the US/Iran ceasefire framework. And the market's reaction, you guys, it wasn't really about politics. It was about energy. And so right now we have a change that is a large ripple effect. For those of you that know, the Strait of Hormuz, it's one of the most important energy choke points in the world. And roughly 20% of global oil consumption is running through this strait that obviously has been closed. And the effects of that are that we've had large increases in oil. We've had large effects in the price of oil. So when Hormuz is threatened, the entire global economy feels it. And we obviously as investors care because energy is the foundation of the cost structure for almost everything, you guys. When oil spikes, transportation costs rise, right? Freight costs rise, construction costs rise, food costs, utility costs, everything really rises because oil touches everything. Energy inflation, it eventually shows up everywhere in the economy. So what's changed here is the ceasefire framework. It reduces the immediate risk of major energy supply disruption. And that has oil prices moved lower almost immediately after the announcement, which is phenomenal news for inflation, right? Markets, they're essentially pricing in less risk of a worst case Middle East escalation is what's happening there. So this removes a major inflationary threat that has been building over the past several weeks. And the important caveat, you guys, is that this is reprieve, not a resolution. The difficult issue, it still remains, right? You've got Iran's nuclear program. You've got sanctions. You've got frozen assets. You've got regional military activity. And a lot of those discussions are reportedly being pushed into future negotiations. So it doesn't necessarily mean the problem is solved right now, but it is being pushed to a later date. And the geopolitical risk, it hasn't disappeared either. It's simply been delayed, you guys. And so this puts some interest rate implications in the news, and it's something we're focused on. And this is why it matters for interest rates, right? Lower oil prices generally reduces inflationary pressures. If there's less inflationary pressure, you've got lower interest rates. Lower inflation pressure can also reduce treasury yield movement. And for us, whether it's the 10-year, the 7-year, or the 5-year, that can dramatically change what assets are valued at. It can dramatically change cash flow. It can dramatically change when you lock a rate, what your interest rate is. Interest rates are basically a control or a chokehold on how much people are able to build and do. When the Fed raised rates back in 2022, a lot of that pain of interest rates rising stopped their ability to be building new product. So you had a bunch of product that stopped being built. When rates were super low back when COVID hit, many builders were building because they were able to finance capital at a very cheap price and to be able to put a lot of things in motion, which gave a lot of jobs, a lot of engine, a lot of gas on the economy. And then as interest rates rose, it caused the economy to seize up and it stopped the dollars from flowing. A lot of people who locked in rates between 2.5% and 3.5%, they're just like, why would I leave that debt? I'm going to leave my equity trapped. And that equity trapped is constraining the economy from flowing. So it does mean a lot. What it does not mean is it does not mean that rates are automatically going to get cut. Okay, it doesn't mean, oh wow, we have a trade agreement, oil prices are down, cut rates. No, that's not what it means. It just means that there's less likely for these inflationary pressures long term if we can keep the price of oil under control. The Fed is not going to change policy because oil dropped for a few days. Okay. The Fed still needs more evidence, really, that inflation is cooling broadly across the economy. And, I have my druthers about what they're saying the job reports are and how many new jobs are created in America. I just would be really, really surprised if the new stats coming out saying 133,000 jobs have been created, because based on the people I talk to, based on what I see firsthand, based off of the many business owners, there's nobody hiring. In fact, most of them are looking to downsize and there's tons of layoffs happening. Here's the three things that I'm watching, you guys, is does oil stay low for longer, right? Do lower energy prices start to show up in the future inflation reports? If they do, it may be more deflationary, right? You've got less pressure on inflation, more likely for rates to drop. Does the labor market remain strong? This is the big question, or elephant in the room, if you will. You, like I just shared, hear all these folks who are cutting, reducing, downsizing, not hiring. And then these reports come out about how there's thousands, hundreds of thousands of new jobs being created. And from my perspective, and I talk to many sophisticated folks, they're all in the same boat and saying, where is this data coming from? Is it accurate? Is it 100% correct? And then obviously, as you all know, or should know, months later, they'll revise the data. By that time, it's old news and it's past and it's not really talked about. And they'll revise the new jobs reports way, way down. So I think the data that you got coming out is not 100% accurate. Why is it that they have to revise it 2, 3, 4 months later with the accurate numbers way down and they can't get it right out of the gate? You tell me. I'd like to know. And you guys, this is not just a geopolitical story, right? This is not just an expense story. Every multifamily owner is affected by energy prices, whether they're aware of it or not, because the fuel costs, the freight costs, right? Construction materials, renovation budget, utility expense, contractor pricing, that's all part of how valuation comes up in real estate. And for value add investors, energy inflation, it hurts both sides of the coin for a value add investor, right? Because the costs go up, right? Of the material, all of the workforce, the hiree, the renovation costs go up, and generally the residents face a higher living costs and they're paying more for their gas. And you look at a normal person who's renting an apartment, their gas bill may be one of the major parts of their bill. Now, if it just went up 25, 35%, there's just less money at the end of the month for those people who are on that fixed income. Now, if energy stabilizes, you've got, renovations becoming much more predictable of how much we have to spend and how much they're going to cost. You've got operating expenses that become more predictable. You got residents that affordability improves, like I just shared, and you've got these collections and occupancy that becomes easier to maintain. And that's the big goal for investors is stability. Whenever there's volatility in a market, that's when investors start to get scared. That's when people start to wonder, do I hold? Do I go? Do I feel confident in the future? Or am I just going to sit back and wait? And that waiting, that holding back confines currency. And when there's less currency flowing, less work being done, that's the time when you see depression or deflation come back into the picture. That's the time when you start to see layoffs creep up. That's the time when the Fed says, okay, wow, all we've spoke about is inflation. We're hitting a point now of deflation. We're hitting the point of too much contraction. We're hitting the point of slowing down too much, and that's when interest rates come in and compensate. What we're watching for today at Granite Towers Equity Group is we're looking to lock in our renovation contracts while costs stabilize, right? We're looking to push delayed value add projects forward potentially if the submarket allows for it. We're looking to revisit our refinancing opportunities. If we get a pullback in rates here, if we get this agreement in place, it may unlock an ability to refinance a variable rate loan that we're in. We still have one variable rate loan left from back when we purchased in 2021 that we are looking to either refinance or potentially sell the asset come the end of the year. And if we can get a pullback in 5, 7, or 10-year rates, Now our loan proceeds go up and it allows us to refinance into fixed debt, hunker down and hold to wait that further out. Going to the capital markets for Granite Towers, another thing we're watching for with this agreement is it could bring capital back into markets, right? It could provide more certainty, more stability. And if it can bring some equity investors back off the sidelines, it starts to loosen things up. Family offices and institutions, they're generally becoming more active when macro uncertainty declines. And so if there's this macro uncertainty that goes away, it'll loosen up some capital there. And then overall, just a calmer market, it often improves the transaction volume and liquidity. And my bottom line takeaway, you guys, is this is a positive development for real estate. It does remove the biggest inflationary risk that we've seen in a very long time, and it gives operators a window to execute if you really know what you're doing. But I would not underwrite deals assuming the geopolitical risk is gone. This may be temporary, right? We've heard it in the past. All of a sudden it comes back and it's game on. The opportunity is not to get aggressive on assumptions. The opportunity is to get aggressive on execution, you guys. While everyone else is still waiting for clarity, you've got to be great at operating, and you've got to be great at taking out opportunity that comes to the market today, because there is opportunity. There is blood in the streets. I think about the classic line that you hear a lot from Warren Buffett is that when other people are greedy, be fearful. Well, I can tell you guys for sure, and from doing this from 2012 to 2026, the most greedy time I've seen in real estate was 2020 to 2022. And the most fearful time I've seen in real estate has been these last 2 or 3 years, really in the last 6 months. We have more fear in the market right now. And the famous Rothschild sign, the Rothschild family is this multi-generational wealthy family. The line that comes up for me with the Rothschild family is be buyers when there's blood in the street, even if the blood is your own. That doesn't mean you throw your underwriting to the wind. It doesn't mean you buy anything. It means that you go and cherry pick some of the best deals you may have seen in the last decade or more. And then you take that deal and you go in with a strategic value add strategy if needed. Ideally, first value add is you're just buying at a completely different cost basis. You're buying the deal at a completely different level of debt. You're buying the deal in a very stable, unique moment in time where the price is low enough, your debt is low enough, where you're in a cash flow state day one, a strong cash flow state. Then as the market heals itself, which it likely will, because the new supply that's coming is very slim to what we've just gone through. So you give it a couple of years that all that new supply gets absorbed, there's not a lot of new supply to follow, and all of a sudden the pressure comes back on the right locations. If bought right, the debt structured right, a value add strategy is there for when the market heals. That's the opportunity that you have to really drive net operating income and create incredible value for your investors. Thanks for listening to another episode of Keeping It Real Estate. I'm Dan Brisse. We'll see you next week.